Okay, so to be a successful property investor, it's crucial to invest in properties with high depreciation during the early stages. This approach allows you to take advantage of depreciation and deductions as much as possible. Hey guys, Scott here. A question I get asked all the time is, how can an investment property reduce my taxes? So today I'm going to answer that for you really clearly. The chances are right now you are paying way more in tax than you should be. Let's consider a scenario where we own a property valued at $500,000. Now we've got a loan at $450,000 and the interest rate is at 5%. Finally, the property generates a rental income of $500 per week or $26,000 per year. Remember, this is your investment property. I've also included Australian income tax brackets here to make this as clear as possible. Take a moment to work out where you sit. It also wouldn't hurt to open up smartmoney.gov in another tab because this tool is going to help to calculate your exact numbers. Now let's assume we have a job with an annual income of $100,000. Our employer deducts taxes based on the assumption that our income will be $100,000 for the year. However, rental income from our investment property adds to our overall taxable income. In the Smart Money tax calculator, we would put this in the other taxable income box. The formula starts out looking something like this. Annual wage plus annual rent equals taxable income. Now from this, you can also see annual tax paid. At this point, we may not have paid enough taxes, which could result in a tax bill instead of a tax refund. Fortunately, there are deductions we can claim to offset this and ultimately create a massive tax refund for us. Now, what is a deduction? A deduction is when the government recognizes a purchase you made as a business or an investment expense and do not charge you tax on that set amount of money. Essentially, it's the legal way to reduce your on-paper income. We can claim deductions for loan interest rates, rental management, fees, and insurance, just to name a few. Now, these deductions are known as cash deductions because we need to spend money from our bank account to claim them. Therefore, when claiming these deductions, the refund you receive is based on the tax rate of the eligible expenses. In the above example, it's 32.5%. However, there's one factor that truly makes a significant difference in property investing, and that is depreciation is a non-cash deduction or an on-paper deduction. The beauty of depreciation is that we can claim it on our taxes without actually spending any money from our bank account. Most people aren't tax experts and aren't aware of all the claims that are available to them. The true extent of what you can actually claim will blow you away. You can literally claim any legitimate expense from owning or running your investment property. Despite the property's actual value appreciating or remaining stable in real life, the government allows us to claim the depreciating value as a deduction because they classify your investment as an income generating exercise. Let's say that carpet has been valued at $4,000 and the ATO evaluates that the carpet has an effective lifespan of 10 years. This means that in 10 years, the carpet will have fully depreciated and be worth nothing. Seeing as it's an investment property expense, you can claim the $4,000 back for the carpet. Now you can't claim the entire $4,000 back in the first year. Remember, it has an effective life of 10 years. What you can do is claim the $4,000 back incrementally each year for 10 years. But this doesn't stop at carpet. Here are a few of the items you can claim as expenses. Your interest, property management fees, gardening and mowing, bank fees, cleaning and maintenance, rates and insurance, cutting keys. There are over 200 items you can claim in advance every year. Depreciation can be claimed on things including your share of common facilities in a multi-residential property, wall paint, and your furniture. You can even claim back the actual value of your building at a rate of 2.5% a year. The best part, you can start claiming depreciation on the property and the total amount borrowed straight away. Now, our formula looks like this. Annual income minus deductions equals new taxable income. This also gives you the new annual tax paid. This deduction effectively reduces our taxable income on paper. While our taxable income initially increased to $126,000 with the rental income, it can be brought down to $83,000 through depreciation. Consequently, we end up paying taxes on $100,000 when our revised taxable income is actually $83,000. This results in a tax return. The refund is calculated based on the tax brackets, with the first $13,000 refunded at 37%, and the remaining amount at 32.5% since it crosses the $87,000 threshold. With these new figures, we can now see our tax savings. New annual tax minus annual tax equals our tax savings or our tax refund. Okay, so the full equation looks like this. So here's the really big and important thing. For many people, this revised tax figure is tens of thousands of dollars less than what it was before. In this case, the tax return for the property is an incredible amount of $5,931. This significant refund translates to approximately $100 per week that you can put towards your investment property to pay down debt or to even increase the amount of properties that you own. Smart investors know that the effective use of depreciation significantly reduces the overall expenses of owning an investment property. This will place you in the strongest financial position to weather any market changes, including interest rate rises. Remember, as interest rates increase, so does your tax return. This could even boost your equity to reinvest when you identify the right property. This is why buying an older property that has minimal depreciation is a common mistake. Remember the hypothetical earlier. If the carpet life is 10 years, then after those 10 years, it's worth nothing. If you buy that carpet and it is already 10 years old, you cannot claim any depreciation on that carpet. This is why brand new property is the best tool for minimizing tax, no matter your income bracket. It's the only investment method which appreciates in capital growth while you pay it off. If you want to know more about how to buy brand new property safely, I've got a video on just that. You can check it out right here. To be a successful property investor, it's crucial to invest in properties with high depreciation during the early stages. This approach allows you to take advantage of depreciation and deductions as much as possible. So there you go. If you enjoyed this video, be sure to give it a like and consider subscribing to my channel where I help everyday Aussies make smarter investment decisions. See you in the next video.